IMF and the midterm review of the Zimbabwean Finance Minister Tendai Biti call for acution. Yet local companies are much more upbeat, according to an assessment from Imara Asset Management in Zimbabwe, a subsidiary of the Pan-African Imara Financial Services Group. Joining us now on the real size of Zimbabwe's economy is Equity Analyst Percy Takunda from Imara SP Reid. Okay, Percy, thanks for coming through. Let's just deal with the facts as being presented. The IMF estimates that the value of the Zimbabwean economy, or what it's worth, is 5 billion. Revised figures late in 2009 by the Zimbabwean Treasury suggest 3.5 to 5 billion. Do you concur?
No, we think that number is much lower than what we perceive the economy to be. There is currently in Zimbabwe, the Central Statistics Office is not as functional as it should be. So that number by the IMF and the government, what they're using basically is their best estimate. But our method that we've used to value the Zimbabwean economy puts, relevant questions to the evaluation.
All right, let's look at the methodology that's used without going into too much technical detail and the shortcomings, because the argument is that the Zimbabwean authorities and the IMF have used Zambia as a yardstick because there isn't that statistical infrastructure within Zimbabwe.
Yes, that's where we start asking the questions. So what we've basically then done is we've looked at key sectors, key industrial sectors within the economy, and we've compared Zambia and Zimbabwe. And what we've seen, historically, Zambia's economy was probably sometimes even 50% less than Zimbabwe's economy. This was when Zimbabwe was doing very well. But during the lost decade of Zimbabwe, things did obviously, take a bit of a dip. What we looked at was, for starters, the beverage industry in terms of alcohol sales. Zambia's key two producers of beverages basically are looking at around $230 million worth of revenue, but on Zimbabwe's side, we're looking at 324 million. So already there you see Zimbabwe's beer industry, if you want to call it, is already larger than Zambia's. You look at Zimbabwe's mining and resources. We look at what is going to come out of the platinum, diamond mining, and we can even add a bit of agriculture there. Our numbers are showing us that we can easily have revenue turnover of about 2 billion.
So what do you estimate the size of the Zimbabwean economy to be, or the worth?
Like I said earlier, currently in Zimbabwe, you don't have a Central Statistics Office that's giving you reliable information. So what you have to do is basically your best bet.
What's yours?
Our best bet is that the Zimbabwean economy is probably worth between 8 to 10 billion. The reason we come to that number is because we've looked at a number of factors, across the board. Consumer expenditure in particular, from SPAR, INSCO, which is a takeaway outlet. You also look at Colcom. Those three companies alone combined could easily have 1.1 billion worth of consumer expenditure that they're going to be driving. We haven't included TM and OK Bazaars, which are big supermarkets in the country. And if you look at it from that perspective, the government has just given us a budget of 2.3 billion. That's what their target for 2010 is. But now look at it this way. From the mining's perspective, you've got Zimplats and Maroa under Rio Tinto. They are easily spending combined 1 billion in capital expenditure over the coming year, and the revenue that they're going to generate from there is also quite significant. The numbers just don't add up.
Before we look at the conglomerates then in industry and mining, let's talk about this issue of consumer spending, just the nuances that you've picked up. There is a concern that unemployment is really high in Zimbabwe, even though now you've got a unity government, you've got a dollarized economy. The figure's in excess of 70% unemployment. So where would the purchasing power come from?
That's a very good question. But now let's look at it this way. In the 10 years that Zimbabwe has been under a lot of stress, that 70% unemployment has basically found a means to survive. So what you have is a 70% official unemployment. But if you want to call them wheeler dealers, the amount of activity within the economy itself could easily be pushed, the formal employment maybe to as low as maybe 50%. I'm not going to be too optimistic on that number, but what I can tell you is that the amount of money that people have to spend is not necessarily reflected by the employment rate. Zimbabwe is not as sophisticated as the rest of the world, where you use employment as your benchmark for expenditure. We do have a lot of informal employment and informal trading activity. That's a huge part of the economy, which is not incorporated in those numbers.
Right, let's talk about investment patterns in Zimbabwe. We're told that its agricultural component tourism and manufacturing all together give it an edge over other SADC states such as the Zambias, the Malawis in the region. Why so? Because we've told although the infrastructure exists from previous years, the investment has been scant because of governance and political risk issues, and those who need to invest have to refurbish the infrastructure, and so there's been a tendency for investors to hold back.
Yeah, also we have to look at it from this perspective. What do we call infrastructure? If you look at Zimbabwe's hotels, you're not going to build new hotels. You're not going to build probably new beds. What you're going to probably try and do is revamp them, modernize them, and maybe create some room for expansion. That's the tourism you're talking about. So the hotels, in a sense, are there. That's the infrastructure we're talking about. When we talk about other things like roads, perhaps, and your electricity supply, which has been erratic, I must admit, those areas need significant capital expenditure by the government and your central authorities. But as soon as that kicks in, and your mining companies have assured electricity supply and all those other things, it will translate to improved economic activity in the country.
All right, those mining companies, let's talk about them a little bit. We know that both the Zimbabwe Chamber of Mines and the Treasury believe that mining growth could be about 31% in the year going forward. But we do know that a lot of mining investments have been eaten up, for lack of a better phrase, by issues of having to augment energy supply. So whereas a company should be thinking about expansion, they're busy buying UPS systems and generators because there isn't a steady supply of electricity, and they're having to service those costs.
Yeah, our point of view on this one is, Zimbabwe is a nation in transition. What we understand is what happened over the last decade was very, very bad and detrimental to the economy of the country. Now you're coming off from a base that's very low. Electricity supply is a very, very simple problem to fix if you can increase your generating capacity and all those other things that follow. But from that point, we say in 31% growth in the next year is actually feasible because you're coming from a very, very low base over the previous years. It might be very difficult, you might argue, to sustain such a growth rate, and that would be a valid argument. But from the base where we're talking about, $1 billion into the Zimbabwean economy could easily, shake up economic activity in mining and agriculture and expand it. Maybe 31% might actually be a very prudent estimate.
Just this last week, we've seen the Zim Industrial Index rise by a very modest figure, over almost a third. And the issue there was that there's been a certification of the Marenge diamonds. Now, why that's important, we've been told by analysts, is that for the first time in a long time, Zimbabwe now has an export commodity, and that's going to pump in liquidity into the system. But when we're looking at potential diamond sales, catalyzing liquidity, you've still got a problem in that economy.
Well, I don't know what they mean by we now have an export commodity because Zimbabwe has always had platinum, gold, agricultural products. There's already been some degree of export activity taking place. It might have not been as high as it should be, but it has been there. What the Marenge diamond certification does is it increases that. Now, the Marenge diamonds, as we're told, are the most significant diamond find of the century. Now, I'm not an expert on the exploration that they did there, but just judging by those numbers, it probably will lead to an increase in your export capacity on the diamond sector. But remember, we also have increasing capacity in platinum, agriculture, gold mining again, which has actually been not being talked enough about. That's also going to take place.
Before we bring in the guest hosts, this increased capacity in agriculture, could you just explain to us what that means? Because the whole world knows about the very sad and tragic issue of land reform in Zimbabwe, how it's played itself out, the restitution of land and land lying fallow right now, not being utilized because there hasn't been any investment in supporting small-scale farmers, etc. The issue, though, is what's been done in the last 18 months of this unity government to boost the capacity of the agricultural sector, because the perception is that land's been redistributed mostly to cronies and is not being utilized, and the agricultural sector by way of export is not operating at optimum level.
No, well, that's very, very true. Zimbabwe's agriculture is not what it used to be. To invest in agriculture, I think one of the most important tenets that you probably first have you probably need to have first is, your security of tenure. When you're going to pump in money into a farm, you want to be sure that you can basically get your money out. So perhaps there's been a lag on that. And this debate about, land distribution and all the stuff that's been going on is very, very true. There has been problems with regards to land reform, and what we would expect the unity government to do is probably reinforce, the tenets that I talked about earlier, which are very important to investment in agriculture. But Zimbabwe does have significant agricultural companies. Seedco, for example, is one of the biggest seed producers in Africa. So perhaps the capacity we're talking about is that capacity in, your already standing corporates, increasing their capacity. This is a very complex situation whereby, these new farmers, as you want to call them, or cronies, are not going to learn farming in a day. That's my opinion. I don't think it's going to actually go to the levels that it was a few years ago. You probably expect maybe at least another decade for it to get to that level.
All right. This is a breakdown of what could have boosted Zimbabwe's economic value. What do you make of everything that's been said here?
Loretta, I love the story, and I'll tell you why. Because we name it something in the investment industry. We call it inefficiency in markets. And generally what happens is when you've got a huge amount of information that flows out of an economy or that is available about an asset class or a company, generally what you find is that information hits the market and prices adjust pretty quickly to the information that is available. And this is generally this case where you've got very, very liquid stock markets across the globe and where information is just available quickly and effectively. The US being an absolutely prime example of this. The Zimbabwean economy is completely the opposite. Very little information that's available. Most people that know something about this economy have to actually go there. Central statistics, it's dubious at best. You don't know if those numbers are right. And most investors at this stage is either staying away or alternatively they can't rely, and previously they could rely on something like the IMF, they can no longer do it. So your inefficiency creates these massive business opportunities and potentially great investment opportunities, which means the value that the asset is actually worth and where it's trading is a major gap. And this is what we invariably then call in the investment industry a 10-bagger, the ability to make a huge amount of money over a certain period of time.
All right, a banker here, speaking banker speak, and one of the issues that people will be looking at is stock market capitalization in Zimbabwe. We know that by late last year, despite all that was going on, it was one of the top 5 performing bourses in Africa. I don't know whether it's moved further up on the ratings ladder, but what is it about people moving into the stock market, into equities, for instance, that keeps them away from FDI and physically investing into the country?
Well, you have to understand there are many functions of the stock market, and in Zimbabwe one of the most important functions of the stock market was that it was actually a source of liquidity. When the Zim dollar was failing, people probably put more faith in investing on the stock market, perhaps as a currency rather than the traditional investment you have in stock markets. So that created a lot of activity, and obviously it translated to more interest, and everybody probably in Zimbabwe now knows a bit about the stock market. Now, if I step back a bit, that developed financial market that you have in Zimbabwe has now become the only gateway that you have companies of coming in. Your FDI, for you to come in and put in your money, you're still going to require a number of security provisions for you to secure your investment. So because of the regulated nature of the stock market, you then jump a few hurdles that you probably have to go through when you invest the money at a personal level or as FDI.
Just very briefly, stock market capitalization is estimated to be somewhere in the region of 3 billion. It's quite cheap to get in there.
Well, like I said, if we're going to value this, if we're going to value the economy at 5 billion today, and we say the stock market is 3.5 billion, if you basically use a multiplier there and you say the economy, well, we think it's 8 billion, put a multiplier, that means the 3.5 billion should probably translate to about 5.6, 5.8 billion dollars, or at the top end, about $6 billion. So that's where our valuation of it being cheap comes from.
All right, finally, let's talk about growth figures, reforecast from 7% to about 5.4%. We know inflation is just slightly above 6%, not quite what the Treasury was hoping for. The IMF had revised that figure down to 2%. So what is it exactly? Is it 2% growth, or is it 5.4% growth? And what are the chances of it becoming 7% growth? And within that, what's GDP per capita? Because we're told it's about $450.
But the first measure that you have is already distorted. If your 5 billion valuation is inaccurate, how is your growth on that one going to be accurate? So in our view, we basically think your first number is wrong, definitely your second number has to be wrong. We're not going to put growth estimates on the economy, because until the Central Statistics Office is functional, and which we are told is supposed to happen sometime in 2010, when that happens and information, as my colleague here said, becomes available, people understand what they're comparing Zimbabwe's economy to where it was before. Right. You're then going to see a proper, proper analysis of growth rates and all these other figures that they're talking about.